Congratulations, you have chosen to be a financial advisor. Did you know, being a responsible financial advisor meant you are into a noble profession apparently never before? You would be impacting the lives of millions in your network positively, adding value to your customers' financial planning and safeguarding their family uncertain future in the absence of the breadwinner. What more? Globally, insurance industry contributing millionaire advisors every year and are rewarded for their every single effort. All it needs your passion to learn and earn, in my view, having spent over 22 years in the BFSI. Time to address the financial deficits, time to embrace your goals, time to give the best to self and for your loved ones, time now, to never compromise but to hit the gold mine. If you agree with me, that you will become what you think, the simple law of attraction, then this is the time, to dial the insurance company of your choice to add value to your life as well to those who are looking for your valuable advice. Here are professionals across the insurance industry, to handhold you and guide you to achieve the aspirations of your life. Time last, is last. Let the past bury the past, no more days of despair and nights of tears but the days of winning are awaited, because you are a born winner. I say this because, so far, you did win many hurdles for your loved ones. Welcome to the world of opportunities and congratulations, for choosing to tread the path of a noble profession being a financial advisor. Wishing you a great luck.
Hello everyone. I am here to help you, to clear your IC38 exam, in your first attempt itself. But on a condition, that you will watch the complete video of mine, and listen to my instructions, which I have shared step by step in this video. Friends, this video series is completely different from any other existing videos related to IC38, clearing the mandate exam to be certified as a life insurance agent, as per Insurance Regulatory Development Authority guidelines. Guess why this video series is unique? Any thoughts? Let me help you. In this video series, 1. We have simplified the chapters so that any common man can understand. 2. You would learn not only the chapters in our Kinetic Animated video series but also you will be learning the answers for the possible questions from each chapter, and the same is designed by our former Learning and Development Head Mr. Anand, who is a practitioner in the BFSI for over 22 years. 3. You would be guided on the earning potential. 4. You will be assisted with your goal setting. 5. The video series will have voiceovers of the language of your comfort. This will help you learn the subject in your mother tongue. Good luck and happy learning. Wishing you a great success for your upcoming IC38 exam.
I am confident, by now, you are more curious to know your earning potential, isn't it? Let me help you to understand the gold mine of opportunity in the form of commission, waiting for you from the life insurance industry. For endowment or a term insurance or a unit-linked insurance single-pay plans, insurance companies offer 2% upfront commission. Example, you have sourced a term insurance policy, a single-pay or one-time premium of rupees 10 lakhs. You will earn rupees 20,000, and if it's 1 crore, you would earn straight rupees 2 lakhs as your upfront commission. Note, few customers would opt for a single-pay, considering no renewal headache. It is observed that single-pay plans are quite popular among the HNI segment. I am sure you have such prospects in your contacts, isn't it? Let us say, you have sourced a money-back plan, premium paying term of 15+ years, you will earn an upfront first-year commission anything between 15 to 21%. Let us take another scenario, wherein you have sourced a unit-linked insurance plan, regular premium. Guess, you have an upfront first-year commission earning potential anything between 20 to 40%. Note, the commission structure might vary from product to product depending on the term, also might vary across life insurers. Are you excited? Working for a life insurance company as a professional financial advisor is always been rewarding beyond your expectations. For more details, please contact your life insurance company.
Well, passionate individuals like you will not only qualify for all the contests launched by your insurer, but also winners like you aim at international recognition. When you think of international recognition, it is MDRT, Million Dollar Round Table membership. Just imagine how proud you would be, and your family, when you are recognized at an international platform. Did you know? MDRT is an international premier association of financial professionals, of more than 62,000 of the world's leading life insurance and financial services professionals, from more than 500 companies, of over 69 countries. MDRT members demonstrate exceptional professional knowledge, strict ethical conduct and outstanding client service. MDRT membership provides a unique mix of resources and networking to inspire growth in your business. Innovative ideas are shared by MDRT members from around the globe during annual MDRT meets. To qualify for the membership of MDRT, agents have to earn the prescribed first-year commission, excluding the bonus commission or brings prescribed first-year premium during the calendar year 2021, shown at my background. Quickly for your information, to qualify for the MDRT this year, your first-year earned commission should be rupees 7,34,700. Note, the premium sourced in rupees should be 29,88,800. The income from insurance sales should be rupees 12,72,500. For more details, contact your agency manager. I would like to wish you very best in advance. You are someone exceptional and I foresee you qualifying for the MDRT membership. We live in a world of uncertainty. We hear about trains colliding, floods destroying entire communities, earthquakes that bring grief, young people dying suddenly prematurely. Why do these events make us anxious and afraid? The reason is simple. Firstly, these events are unpredictable. If we can anticipate and predict an event, we can prepare for it. Secondly, such unpredictable and untoward events are often a cause of economic loss and grief. Insurance has been known to exist in some form or other since 3000 BC. Various civilizations, over the years, have practiced the concept of pooling and sharing among themselves all the losses suffered by some members of the community. Let us take a look at some of the ways in which this concept was applied. How insurance works. Firstly, these must be an asset which has an economic value. The asset may be physical, like a car or a building, or 2. May be non-physical, like name and goodwill, or 3. May be personal, like one's eyes, limbs and other aspects of one's body. B. The asset may lose its value if a certain event happens. This chance of loss is called as risk. The cause of the risk event is known as peril. By transferring the risk to an insurer, it becomes possible to enjoy peace of mind, invest funds that would otherwise have been set aside as a reserve, and plan one's business more effectively. It is precisely for these reasons that insurance is needed.
Let us continue our understanding on how insurance works. There is a principle known as pooling. This consists of collecting numerous individual contributions, known as premiums, from various persons. These persons have similar assets which are exposed to similar risks. This pool of funds is used to compensate the few, who might suffer the losses as caused by a peril. This process of pooling funds and compensating the unlucky few, is carried out through an institution known as the insurer. The insurer enters into an insurance contract with each person who seeks to participate in the scheme. Such a participant is known as insured. Did you know? Currently, there are 24 life insurance companies operating in India, as detailed hereunder. Life Insurance Corporation, LIC, of India is a public sector company. There are 23 life insurance companies in the private sector. The Postal Department, under the Government of India, also transacts life insurance business through postal life insurance, but is exempt from the purview of the regulator. Till now, foreign direct investment in the insurance sector was capped at 49%. However, the central government latest decision, Union Budget 20-21, to allow 100% foreign direct investment for insurance intermediaries should bring in global best practices.
Hi, let us continue our learning. I will be sharing here with you certain key points to remember from your examination perspective. Any of the points highlighted are important. Also an instruction for the benefit of you all. Request you to keep making your notes while you are listening. Learning gets reserved. If we listen to what we watch what we listen and practice what we learnt. With that, let us begin our learning journey. Did you know? Insurance Regulatory and Development Authority of India is the regulator for the insurance industry in India. Insurance Regulatory Development Authority of India is established in the year 1999. 2. The need for setting aside reserves as a provision for potential losses in the future is a secondary burden of risk. The secondary burden of risk consists of costs and strains that one has to bear merely from the fact that one is exposed to a loss situation. Even if the said event does not occur, these burdens have still to be borne. Firstly, there is physical and mental strain caused by fear and anxiety. Secondly, when one is uncertain about whether a loss would occur or not, the prudent thing to do would be to set aside a reserve fund to meet such an eventuality. If so, what is primary risk? The primary burden of risk consists of losses that are actually suffered by households and business units as a result of pure risk events. These losses are often direct and measurable and can be easily compensated for by insurance. 3. Insurance is a method of risk transfer. 4. The breadwinner of a family might die untimely, leaving the entire family to fend for itself. Such a scenario warrants purchasing of life insurance. 5. The Jan Arogya insurance scheme is run by an insurer and not sponsored by the government. 6. Risk transfer through risk pooling is called insurance. Remember, these bullet points are sourced from the IC 38 Handbook for Advisors, published by the Insurance Institute of India. To note, one should remember these bullet points, since there is a high possibility of questions being framed on the same.
Let us continue our learning. Here are the key points you should remember from your IC 38 exam point of view. 1. The Life Insurance Companies Act, 1912, made it compulsory that the premium rate tables and periodical valuation of companies be certified by an actuary. 2. The Insurance Act 1938 was the first legislation enacted to regulate the conduct of insurance companies in India. 3. Life insurance business was nationalized on 1st of September 1956 and the Life Insurance Corporation of India, LIC, was formed. 4. With the enactment of General Insurance Business Nationalization Act, GIBNA, in 1972, the non-life insurance business was also nationalized. 5. In 1993, the Malhotra Committee was set up to explore and recommend changes for development of the industry, including the reintroduction of an element of competition. Please note the highlighted points across each statements in the slide, which are considered important from the examination point of view. Hope all of you are listening, watching and making notes. We will do a quick recap towards the end of the session. I am sure you are enjoying your learning. Let us continue our learning journey. I will do everything possible to make it simple, so that all of you could remember the key points from each chapter. Alright, here are other key points to ponder from the examination perspective. 1. An insurance arrangement involves the following entities like asset, risk, peril, contract, insurer, and insured. 2. When persons having similar assets, exposed to similar risks, contribute into a common pool of funds, it is known as pooling. Remember, insurance works on the concept of law of large numbers, or in other words, pool the money and share for the possible economic loss. 3. Apart from insurance, other risk management techniques include A. Risk avoidance. Means, controlling risk by avoiding a loss situation is known as risk avoidance. Example, one may not venture outside the house for fear of meeting with an accident, or may not travel at all for fear of falling ill when abroad. I am sure you agree with me, risk avoidance is a negative way to handle risk. Individual and social advancements come from activities that need some risks to be taken. B. Risk control. This is a more practical and relevant approach than risk avoidance. It means taking steps to lower the chance of occurrence of a loss and or to reduce severity of its impact if such loss should occur. Example, holding regular fire drills for employees, or ensuring adequate training of drivers, forklift operators, wearing of helmets and seatbelts and so on. Another example of this can be educating school-going children to avoid junk food. C. Risk retention. Here one tries to manage the impact of risk and decides to bear the risk and its effects by oneself. This is known as self-insurance. Example, a business house may decide, based on experience about its capacity to bear small losses up to a certain limit, to retain the risk with itself. D. Risk financing. This refers to the provision of funds to meet losses that may occur. E. Risk transfer is an alternative to risk retention. Risk transfer involves transferring the responsibility for losses to another party. Here the losses that may arise as a result of a fortuitous event or peril are transferred to another entity. Insurance is one of the major forms of risk transfer, and it permits uncertainty to be replaced by certainty through insurance indemnity. The thumb rules of insurance are: A. Don't risk more than you can afford to lose. B. Consider the likely outcomes of the risk carefully. And C. Don't risk a lot for a little. The term reinsurance is also known as insurance for insurers or stop-loss insurance. Reinsurance is the practice whereby insurers transfer portions of their risk portfolios to other parties by some form of agreement to reduce the likelihood of paying a large obligation resulting from an insurance claim. The measures to reduce chances of occurrence of risk are known as loss prevention measures. By transferring risk to insurer, it becomes possible to enjoy peace of mind and plan one's business more effectively. Origins of modern insurance business can be traced to Lloyd's. In the insurance context, risk retention indicates a situation where one decides to bear the risk and its effects. Insurance is one of the major forms of risk transfer, and it permits uncertainty to be replaced by certainty through insurance indemnity. Insurance refers to protection against an event that might happen, whereas assurance refers to protection against an event that will happen. When we speak about a risk, we are not referring to a loss that has actually been suffered but a loss that is likely to occur. It is thus an expected loss.
Now let us learn the social security schemes. RKBY means Rashtriya Krishi Bima Yojana. RSBY means Rashtriya Swasthya Bima Yojana. PMJBY means Pradhan Mantri Jeevan Jyoti Bima Yojana. PMSBY means Pradhan Mantri Suraksha Bima Yojana. Please remember the above social security schemes from the examination point of view.
Did you know? Amicable Society for a Perpetual Assurance is founded in 1706 at London, is considered to be the first life insurance company in the world. The Oriental Life Insurance Company Limited is the first life insurance company to be set up in India, was an English company. Triton Insurance Company Limited is the first non-life insurer to be established in India. Bombay Mutual Assurance Society Limited is the first Indian insurance company. It was formed in 1870 in Mumbai. National Insurance Company Limited is the oldest insurance company in India. It was founded in 1906 and it is still in business. Request you to remember the name of the insurance companies and the year of inception from the examination point of view.
So far, we have understood the first chapter, Introduction to Insurance, from the IC38 book, published by Insurance Institute of India and based on the revised syllabus. Now it is the time to test how much you remember. Friends, let us play the quiz. Who is the champion? If you answered right, you will score 1 mark each. If your answer is wrong, you would not get marks. Good luck and let us begin the quiz. Congratulations! You have understood the first chapter, Introduction to Insurance, from the IC38 book, published by Insurance Institute of India. Request you to once again revisit your learning from the video, the time of your comfort. Remember, unless we practice what we learned, 80% of the learning, we might forget since we are adults. Good luck and await now for the second chapter Kinetic Animated Video, which is coming soon.